All right, welcome to another ICT video. Today we're going over daily bias. All right, so here we're going to be marking out internal and external liquidity on the daily chart. And the reason for this is so that we can mark out what type of liquidity has been taken and where price is most likely to head, depending on what type of liquidity is taken. So we have external and internal liquidity, external being swing highs and swing lows, and then internal being fair value gaps. So this candle right here ends up taking both internal and external. So we're going to go down to the 4 hour to see what's really happened. So click here, we've taken external liquidity and now we're moving into internal. So price is always doing one of two things, either moving from internal to external or external to internal. And here we see price takes out a swing low and moves back into internal. So now that we've taken out external liquidity, we should expect price to move back into internal and then react back down. So let's see what happens. So price ends up moving even more up, and this is why you don't want to just use the daily chart. You also want to use the 4 hour. So here we also inverse on the daily, which confirms our bearish bias. So we've gone into internal, and now we're moving towards external. So we've created an inverse fair value gap. We have external liquidity down there. We expect price to go and take that out. And we see that it does. So now that we've taken out external liquidity, we can expect price to now move back to internal. And we've also left a imbalance in the form of FVG, a bearish FVG. So we could expect price, if it is reacting off of it, to move back to internal. Now you'll often hear people say wicks do the damage, bodies tell the story. And what we mean by that is the wicks take out the liquidity, and based on how the bodies close, you can tell which direction price would most likely want to move to. So because we wicked off of the external liquidity, we can see that we are most likely going to be moving towards internal liquidity. And then we wick the internal liquidity, and then we don't have a closure above it. So we can expect price to then move back to external. So looking how the body is closed is very important. So we don't have a candle closure below this external liquidity point, so we can expect price to move upward back to internal, which is exactly what it does. And because we don't close above this internal liquidity, we can now expect price to move back down to external. And what do we see? Price doesn't go back down and instead moves upward. And this is why none of this is guaranteed. All of the daily bias procedures that we use, none of it's guaranteed. So that's why you use the lower time frames to get a better understanding of where price is most likely to go based on the order flow on multiple time frames, right? We're trying to form a narrative based on multiple time frames. So we do have external liquidity, and we do end up inversing that fair value gap, which makes it an ifvg, confirming that there is bullish intent in the markets, and we end up going to external liquidity. So the concepts still work, but you have to make sure that you are timing them properly based on the order flow that you see on the lower time frames. So here we have external liquidity resting very near. Let's see if price wants to take it out or head back down to internal liquidity, which we can see down there in the small fair value gap. So we end up taking the internal instead, but we do end up wicking off of it. So that would mean that we would expect price to go back up to external liquidity, which is the drawn liquidity in the form of equal highs, or the sell side liquidity up there. So let's see what price wants to do. So it seems that we're holding this gap right here. This could be a new week or new day opening gap. We're wicking off of it. So by that logic, we should expect price to go back down to external liquidity. So this is what we mean by wicks do the damage, bodies tell the story. We look at the candle closures in order to see whether price is rejecting or continuing off of certain areas. So we can see that price is rejecting off of this gap. So most likely we're probably going to go for external liquidity down below. And we can see that price doesn't end up doing that and instead continues to go higher and eventually inverses this gap. So price can do whatever it wants when it wants. So that's obviously something you want to keep in mind when you're forming your bias. So what we see here is price inversing this gap. So we would instead think that price is going to displace through and go over to the draw on liquidity. And that is exactly what it does. So we're taking the information that we're given and framing our bias off of that. You can follow us on X or find us directly in our Discord.